as millions of Canadians approach the mortgage renewal cliff in the coming weeks, the coming months, and years ahead. A lot of financial pressures are going to be put on households as well as the Canadian economy. And we're starting to hear more about these higher interest rates for longer. And we're getting reports from CMHC, the Canadian Mortgage and Housing Corporation, regarding some of the statistical data and what's happening with lenders, insured, uninsured mortgages. And on this week's episode, we'll talk about a little bit of the delinquency rate, what's happening here, this two-sided story, as CMHC did release their residential mortgage industry report for fall 2023. And we're going to talk a little bit more about some of the options, some of the solutions that you as a Canadian with a mortgage can utilize or maybe plan for, especially if your mortgage is coming up for renewal. And this is very, very important. So welcome back. It's Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. And if you're new to the channel, we invite you to subscribe, hit that notification bell so you get notified every single time we post a new video, and let us know in the comment section below what you think about the Canadian mortgage and real estate marketplace. So first and foremost, it's important to understand that not only is CMHC, the Canadian Mortgage and Housing Corporation, concerned with what's happening with mortgage renewals. We have OSFI, the Office of the Superintendent of Financial Institutions, also talking to these banks and saying, look, you need to do something with these negative amortizations, these mortgages with extended amortizations. So this is a big problem. You have the federal government, basically sounding the alarm bells under this housing crisis, this affordability concern. This is going to be the platform for the next election. And obviously this is a major hotspot. Many Canadians who are or have already renewed their mortgages are feeling these pressures. Now, obviously, it depends on your household finances. If you're making good money with small mortgage, obviously these changes are going to be, impactful. Maybe it's going to, divert some of your spending. But for some individuals who are paycheck to paycheck, some of them who might have lost their jobs or their economic situation had changed, these potential higher interest rates are definitely going to wreak some havoc. And that's what is coming out of one of the articles from CMHC talking about these higher interest rates and how it's going to be impactful on Canadians, especially when we think about $15 billion of mortgages that are going to be renewing in the next little while. This is really a big number. So, before we look at some of these other points, it's important to understand in the report, they talk about what is happening with lenders. So obviously consumers are changing their course on how they're selecting their mortgages at renewal. We've always been advocates for getting the lowest rate for the longest period possible, but when interest rates were lower prior to the pandemic, 5-year products were obviously the go-to if you were planning to stay in your home for a long period of time. Obviously, some individuals short-term, variable rates, different conversation. Now, after 2022, when the Bank of Canada started hiking its policy rates, well, variable rate mortgages were less attractive. And there was more demand for fixed rate mortgages, especially in that 3 to 5 year range, right? And this was something that was pointed out in the CMHC report. And as the CMHC sees that there's a lot more demand for uninsured mortgages as there was for potentially insured mortgages. Now, this I found interesting, especially being in the GTA. Obviously, if you think about what's happening here, most Canadians who are buying a home in GTA Central, obviously Vancouver, Greater Vancouver area as well, you need it to have 20% down if you're purchasing a home that is over $1 million. And if it's less than $1 million, well, then you had an option to qualify under the insured guidelines. But as these interest rates began to get higher and that mortgage qualifying rate became even further and further out of reach, right, where for qualification purposes, many Canadians found that they couldn't qualify for an insured mortgage. Even if the home was below $1 million, they were forced to sort of come up with that 20% in order to qualify. And there's so many different conversations that are coming out when I'm reading this article or this report, I should say, and say, okay, yes, I get it, but what about the rest of Canada, right? So the other pockets, when we talk to other colleagues that are in our network across Canada, homes in the prairies out east, where the home prices are definitely more affordable and obtainable, an average person can buy a home with less than 20% down. It's just these two hotter markets that are really impactful, and that's the data that I'm pulling up from CMHC as well. Now, the delinquency rates, according to CMHC, is still historically low. And that was sort of echoed by Deputy Governor Carolyn Rogers just last week in a press conference where she was talking about obviously higher interest rates, maybe remaining here for a longer period of time. And I say maybe because obviously the variable rate, the policy rate, the monetary policy direction for the Bank of Canada might opt to stay that way. Maybe they're using very aggressive language to sort of, fear many Canadians into that's going to stay higher for longer. But generally, the consensus amongst economists is that the Bank of Canada is pretty much at their wits' end when it comes to their policy rate, especially in comparison to the US. So we're looking at these things differently. So yes, it's important to understand the Bank of Canada prime lending rate, which is directly impacted by the Bank of Canada's policy rate decisions, impacts your variable rate mortgage, but fixed rate mortgages are independent of that and they're based on the bonds. And over the last little while, we've seen some volatility in the bond market as a result of what's happened with some of these US treasuries, the 10, the 30 year, but more importantly, their inflation data, right? Their inflation data, its trajectory is basically come down. And the anticipation is that that's gonna happen here in Canada next week when we get the Stats Canada report on those CPI numbers. And if we start to see that sort of in line, then maybe, just maybe, the Bank of Canada is going to hit that pause button again. And right now, economists are projecting that the Bank of Canada is going to remain on the sidelines right now and continue that pause as it assesses what's happening. As we see this mortgage renewal cliff, we look at the economy, we've seen that uptick that we've talked about in unemployment, it's starting to come out. When we start to pull back on consumer spending, right? Your money that you spend in the economy is somebody else's income. So if you're not spending that money in the economy, well, then someone else is not making that money, and therefore that business may have to pull back. They may need to lay off individuals or maybe not develop different programs or different services within that business. So it's a cyclical impact when consumers stop spending. And obviously this is as a result of those higher rates that we've talked about ad nauseum here on the channel. Now, with that being said, obviously we talked about $15 billion of mortgages. Those are going to be renewed over the coming years ahead. And obviously this is going to impact Canadians differently depending on where you are, what type of mortgage you have, the size of your mortgage. It could be, basically in essence around a 40% bump up if interest rates, fixed rates don't start to come down. And if they continue to rise, that could be even more. And this is also pushing many Canadians into shorter term mortgages. And this is the conversation that we're having with our clients daily is what do you think is going to happen, right? Because we could tell you, hey, we think potentially, eventually this too shall pass and we're going to start to come down on those fixed rate mortgages, but it's not going to be at the level we saw in 2021, 2022, early part of 2022, those really, really low rates, those historically low rates, I think those are not going to come back. But we may end up around 4.5%, 5%, in and around that range, which was where we were prior to 2020, right? Before the shutdown happened, right? So this is very important to understand. Those were the rates relatively within that range. Maybe we'll go back to those particular style of rates. Let us know what you think in the comments section below. But as we push forward, obviously, what types of lenders are taking different market shares of the mortgage products? And obviously, the major banks obviously have the lion's share of these mortgages. But, we've definitely seen credit unions. We've definitely seen an uptick in alternative lenders and in private mortgages. As qualification becomes more stringent and individuals cannot qualify with conventional banks, they turn to alternative sources to get their financing. And during even the height of the real estate boom, many Canadians who really, wanted to get into the housing market, they weren't qualifying with a bank, even with the low rates, were turning to alternative lenders or private lenders to sort of get those financing arrangements done. So this is something that's really important to understand. And when we start to think about alternative lenders, it's important to understand, and lenders, they don't really like to say that they're B banks, right? But we classify them for simplicity, A, B, and C lenders, right? Because A is your conventional banks, your top tier. Then you have your B, which are your equity lenders. They work with blemish credit. They're a bank. They work with different income validation. Then you have your private lenders on the other end, which are very low income, a higher rate, more risk. it's important to see how Canadians are reacting, especially with renewals. Maybe they're not going to be able to refinance their mortgage. Maybe they'll be deselected from their bank because of their credit. Maybe they've shot their credit down and the bank can deselect them. We've seen it happening with certain lenders, right? If you don't meet their criteria, they'll say, hey, your mortgage is coming up for renewal. We no longer want your business. You need to go find an alternate option. So obviously these are so many different circumstances, but at the end of the day, if you're a Canadian who has a mortgage and it's approaching mortgage renewal and you're concerned with the options in front of you, I want to take an opportunity and go through some of the options that you can look at to help you stay in your home, renew your mortgage, and budget accordingly. So some of the available options that we'll go over very briefly are things like choosing a new mortgage for the terms that reduce the debt servicing cost. Such as longer amortizations, which are something that is very important to understand. So as you approach mortgage renewal, you have the option to renew your existing mortgage, just sign back, and obviously depending on your situation, if your income is the same, you're still employed, you have the option to shop around if you qualify. But if, let's say, something catastrophic happened and you're not able to qualify, you have the option to renew with your lender by signing back. But some clients are looking at it and saying, hey, I have to renew into a higher rate regardless. Let's take the opportunity to refinance that mortgage, take out some equity if you can, and pay off some of these higher debt credit cards or lines and loans, which are very, very important. These are things that are upticking right now, right? So you want to pay very close attention to those options. By extending your amortization, you can help reduce your monthly expenditures. Now, obviously, cutting back on the savings. This is something that, as much as it's counterproductive, we're saying to Canadians, look, you need to save for a rainy day. But if you have those savings, you want to make sure that, either you're utilizing them for the right means in the sense of making sure you have enough money to cover your mortgage payment, but maybe you're putting aside a larger portion of your mortgage. You might want to look at what those payments look like, something we've talked about on the channel. You can download our app in the description box for free and play around where you are with your existing mortgage and your payment and what it could look like. And then you sort of say to yourself, look, I'm saving this much money. Maybe I'm going to maybe increase my mortgage payment, so get more accustomed to a higher mortgage. And in a lower rate environment, if you have a lower rate mortgage, I should say, that money actually goes towards principal. So, and you also build yourself up in the position where you already know what your payment's gonna look like. So you can look at it that way. That's one thing we've advised to some of our clients. It seemed to be working out for them over the last 7 months. And reducing the consumption of non-essential goods and or services. This is something that many of us may find very difficult, right? How much do we order from Uber or skip the dishes? How many times we go out for those dinners? How elaborate are those dinners? Cutting back on those things, maybe doing things a little bit differently is one thing that's very, very important, especially if you're very concerned about what your mortgage will look like in the few months, years ahead. Start to change your pattern so that it doesn't become abrupt when your mortgage actually renews. You're already easing yourself into those potential changes. Delaying major purchases, this is a huge one. Obviously, many Canadians, you need a vehicle, you need appliances, especially if they break down, but sometimes you have to look at those overall costs. If you own your vehicle and you're not leasing or financing it, sometimes you're better off fixing the old clunker if you can, as opposed to getting into a new payment and potentially higher insurance costs, right? So you have to look at all these options, and especially with appliances, get some quotes on, if you can fix it, or just delay those things until you actually have the money to buy them. A lot of people finance furniture, a lot of people finance appliances, so you have to look at those costs. And then preemptively selling your home or property. If the writing is on the wall for you and your mortgage, right? If you know that, look, if I start to run the numbers on the mortgage app that you can download in the description box below, and you're like, wow, if interest rates don't change, we will not be able to afford the mortgage. Don't wait till the last minute to, get your home prepped for sale. Or talk to a mortgage professional, make sure, you've read those options, there's nothing else that you're missing, and see if that's the right option, right? You might be forced to sell, but sell under your own guidelines and your own terms rather than having the bank knocking on your door and missing mortgage payments, further damaging your credit. And finally, the last thing would be prioritizing mortgage payments over those for other, credit products and credit cards, for example, loans and lines of credits, right? This is something that's been very controversial. We've talked to clients about this. you really want to make sure that you're paying your mortgage. Your mortgage, if you miss a mortgage payment, it's pretty bad, right? If you miss one credit card payment and you have a dozen credit cards and that are, on your credit reporting agency, either Equifax or TransUnion, it's not going to be as detrimental as missing a mortgage payment, because as I mentioned, that mortgage payment, if you miss it, that could deselect you from that lender at renewal time. So obviously, if you make the minimum payments on those credit cards and lines of credits, do those things to help yourself stay ahead and on top of your mortgage. And this is something that, we always tell clients, if you're looking at these options, reach out to a mortgage professional, have a conversation with them. Before you potentially look at credit counseling or any of these other predatory lending structures, talk to a mortgage professional, especially if you have equity in your home. You might be able to figure something out that it's going to be more cost effective, because that is the major part of what's happening with the Bank of Canada. Obviously, we're looking at household debt. Debt to income is at around 171 or 172%. Crazy. They're looking at OSFI's looking at what's going to happen with Canadian debt. You have the government talking about, Canadians, more and more Canadians using food banks, their credit cards. All these things are mounting pressures on Canadians. Even though delinquency rates are low, many Canadians might be leaning on their credit cards to make that mortgage payment, to actually make it happen. And obviously that can only work for so long, right? So before you run out of credit, before you're no longer extended any more new credit. So always have a chat with a mortgage professional. I want to hear from you, our viewers. What do you think of, what do you make about this Canadian mortgage real estate market right now? Are we headed into some change? Are we going to see fixed rates come down? What could happen if interest rates drop, right? Will the housing market basically reignite if we see the Bank of Canada pause and fixed rate mortgages come down? Are we not going to learn a lesson here in Canada? Or are we going to learn a valuable lesson going out of this particular very different time here in Canada? But let us know in the comment sections below. We'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead, and we'll see you again next week.